Now, let's talk about the bond market last week because it was crazy. Now, we saw the stock market obviously tank multiple days in a row and then had, I think, the largest recovery it's seen in, I don't know about ever, but I mean, it was a 2,300 point gain in one day when Trump came out and said he would do the 90-day pause on the tariffs. And he takes a lot of credit for that really good day in the market, but really it was just kind of unwinding the tariffs that he announced earlier that week. So I don't know how I feel about that, but nonetheless, it was nice to see that large of a recovery in the stock market so quickly. It really gave me a memory of what happened in COVID. That real V-shaped pattern got created by that. And we're not back to where we were. I think the stock market's just over 40,000 right now. It was about 43, 44 when this all started. So a little bit more room to go to fully make up for everything that was lost in the stock market, but it made a good amount of recovery in a short period of time. But typically, when you see the market tank like that, you would see that money flow into bonds. And you know, it's not that we didn't see that happen. I think we did, but there's a few other things going on with the bond market. Now, it's widely, been discussed, I guess, is China and other countries, are they unloading their holdings of U.S. bonds? I mean, that's a lot of people I've heard say that. I have not seen any strong evidence that that's happening. And matter of fact, watching an interview yesterday with the Treasury Secretary, they don't really think that that's happening. Matter of fact, he pointed to the really strong auction that we had last week, and there was a lot of foreign participation in that auction. So we're not sure that that's what's happening. But what could have happened is that when there's a large sell-off like that in the stock market, there's going to be margin calls. There's going to be need for liquidity. And usually bonds, treasuries are the place where people, those holdings are very liquid. And so we probably saw a lot of liquidating of those in order to create cash to cover margin situations or just really to fund reserves, perhaps, in situations like that. So I think multiple factors contributed to the bond market doing what it did. Now, here we are in a new week, and we are starting off the week. I'm recording this on Tuesday. We're seeing the bond market, mortgage-backed securities specifically, are recovering. So is the 10-year. But let's talk about the volatility we saw last week, because this is crazy. I looked at the candlestick charts for the 5.5 Fannie Mae coupon, and although it didn't close at these levels, the intraday, the wick, if you will, on the candlestick went as high as 101.12 and as low as 97.69. That's a 343 basis point swing, right? Or 3.43 points, 343 basis points. You guys, that's a crazy swing in a 5-6 day period of time. I think that went back looking at the Friday before until the Friday of last week. And that was a massive move. I hope everyone's pipelines were locked, because otherwise, we got some difficulties out there. Trust me, I've looked at pipelines. They're not all locked. I'm sure people are challenged with that. What a good reminder that we're just not in a season where you can float interest rates given this volatility. But nonetheless, here we are sitting today with the 5.5 coupon at 99. So we've definitely recovered from that low, the low water mark of 97.69. So we're up at 99, moving in the right direction, but we need a lot of recovery to happen in the bond market in order for rates to get back to where they were.